We often talk about investing, but we don't talk about the fundamental principle of investing. What does it mean to invest, not just in the stock market, not just in equities, not just in companies, but in real estate, in a farm, wherever you want to invest? The fundamental principle is the same. You have cash today, you're giving that cash away, and you want more cash in the future. This is why people invest. In the case of a company, what you want to do is to invest in a company that the price you're paying today is such that in the future you're making at least a profit. This is the intrinsic value, the definition of the intrinsic value. Let's forget about the stock market here. We are talking about a company that exists today. How much are you willing to pay? And you know that this is the exact value of the company, that in the future, if you pay a little lower than that, you're breaking even, you're making a profit. This is the intrinsic value. In the stock market, what is different is that we have a price that the whole market agrees on. And then we have the intrinsic value that the market may or may not agree on. As value investors, we look for the intrinsic value. And when we buy a stock, it is only when its price is lower than the intrinsic value. So how exactly do we calculate the intrinsic value of a company? If it is so important, it is the most important number you have to calculate for any company. How do we calculate it? It is simple and it is also complicated. Some people make it more complicated than it should be. And today we are going to look at the largest company in the world, Apple. Why I'm choosing Apple? Because it is a company that most people can understand. Most people know how this company operates, what they do, what's their business. There are many people looking at the company. It is the largest company in the world, so we should not really be worried about other things such as liquidity in the stock. And also because this is one of the largest position of Warren Buffett, the greatest investor who ever lived. And if we consider his investments in Apple, maybe we can get some ideas of how the way he thought to invest in Apple. I have this book here which I'm going to read very soon, and security analysis. So we are going to take everything from these books and try to calculate the intrinsic value of Apple. So we said that when we invest in a company, we are giving cash today and we want more cash in the future. So maybe the intrinsic value of a company should be its cash value, how much cash it has on its balance sheet. In the case of Apple, it's only 28 billion US dollars. So is this the intrinsic value of Apple? Of course not, because they have more than just cash. They have also marketable securities. What are marketable securities? These are bonds that can be converted into cash. If you have marketable securities, you can sell the bonds, you can wait for them to mature, and you will have your cash. So the total cash equivalent, and marketable securities that Apple has today on its balance sheet is 166 billion US dollars. So is this the intrinsic value of Apple? Let's say you are able to buy the whole of Apple today. Are you going to get actually that 166 billion? No, you're not, because you still have to pay the debt. The creditors are always above the owners. Whenever there is a company, you have to repay your debt. So we need to know how much debt Apple has. And today the amount of debt Apple has is around 105 billion US dollars. So if, let's say you have 166 billion US dollars in cash, with the debt, you remove the debt, the net cash is 61 billion US dollars. So this is all the cash that remains with Apple after you haven't paid all the debt. So is this the intrinsic value? No. Why? Because we forgot about all the other things. Apple is not just cash. There are other things. What about the offices? What about the buildings? What about the patents? All these are assets of Apple and they need to be accounted for. And there are other liabilities. It's not just debt. For example, a company may be leasing a building. So this is a liability. They may owe some money to suppliers. This is another liability. What about inventory? This is an asset. So all this has to be accounted for. And when we do this for an individual, for a person, we look at the total assets and we minus all the liabilities. This is what we call the net worth of an individual. For the company, we can do the same thing and we have the book value. For Apple, it is about 60 billion US dollars. In the past, book value had a lot of importance, but today not that much, because there's a lot of value which cannot be on the balance sheet. For example, the brand value of Apple, it cannot be on the balance sheet, but this is something that really exists. Now, in the worst case scenario, today I'm not going to go into details about that, there is something called the liquidating value, and it is close to the tangible book value, but there are some things that you need to change, and everything is in security analysis. The best approximation would be the net current asset value of the company. You take all the current assets minus the total liabilities of the company, and you have a good approximation of the liquidation price of the company. This is relevant when the company is being liquidated. In the case of Apple, this is not relevant. So when a company, maybe is going for a bankruptcy, you can use the net current asset value as an approximation for liquidation price. But for Apple, this is useless. So when you are calculating the intrinsic value of a company, every company is different. So you use different ways to calculate the intrinsic value. Let's go back to Apple. So we have the book value, we have the net cash value. Which one of these is the exact intrinsic value of the company? There's more, because we forgot to talk about the brand value, as we said. And this brand value, what does it bring? It doesn't bring more cash immediately to the balance sheet, but it brings more cash flow over the future, over the long term. People today, they buy Apple products every year because they like the brand. And every year, this increases the cash flow of the company. So a company, when we are calculating the intrinsic value, it is the amount of cash the company can give us back. So there is the net cash part, and we also have the cash flow that it can generate in the future. So it's not just about the cash currently on the balance sheet, but about the future cash of the company. So there are two parts of the intrinsic value. And the current cash on the balance sheet, this is easy to calculate because this is right now. But the future cash flows, this is how to calculate, because you don't know how much cash the company is going to produce over the long term in the future. You can always look at the past, but the future may not always be like the past. It is also important to know what do you mean by cash flow, because Warren Buffett talks about owner's earnings, which is different from free cash flow. And once again, for every company, it is different. In the case of Apple, you will see that they have stock-based compensation. We cannot really call this owner's earnings, because eventually this stock-based compensation, even if in the short term it is not a cash expense, over the long term these stocks are going to be given to the employees, not to the owners. So we have to remove this. And if we are looking at, let's say, an insurance company, General Financial, every year you will see that they have expenses which are non-cash expenses. These expenses are the amount of money that they are increasing on their liabilities that they are going to pay to their clients over the long term. So every year it increases, even though it is not a cash expense, but eventually that money is not going to you, it is going to the clients of the company. So you cannot really say that free cash flow is equal to owner's earnings. And there's also the capital expenditures. In free cash flow, we take the total capital expenditures, but for owner's earnings, we take only maintenance capital expenditures. Why? Because the owner's earnings, this is in theory the amount of cash that the company can give to the owners. Now, with this cash, the owners can do three things. They can reinvest in the company, and that is growth. That's why we already removed the growth capex. They can pay dividends, or they can buy back shares. In the case of Apple, they are doing all three. But since we are calculating owners' earnings over the long term, for the future, money today has more value than money in the future. So you need to discount future owners' earnings. What discount rate you are going to use? Some people will use CAPM, WACC, or whatever. I don't know the things, and I don't want to know. Warren Buffett tells us that he uses something very simple, and you need to use a standard candle that it is the same for every stock you are looking at. He uses the risk-free rate, that is 10-year treasury rate. Right now it is around 4.3%. So you can use 3.3%, or you can use something a little higher than that. Why I would prefer we use something a little higher than 4.3%? It's because over the long term, it's not going to be stable at 4.3%. So maybe it could go to 5%, which is the amount I'm using today. But that doesn't mean you have to use it. What's important is that you use the same discount rate for every company. So you discount over the future owners' earnings of Apple at whatever discount rate you choose, and then you add the net cash back, because this is also cash that the company can return to you, and that is the intrinsic value of the company. You have made a lot of mistakes. On the balance sheet part, not that much, because you know how much cash the company has, but on the predictions of the future, how much they can generate, there's a lot of mistakes. If you're assuming growth, there's going to be even more mistakes, Because if there is consistency, you assume that the company is not growing at all, it is easier to make a prediction because you know in the worst case scenario how much they are still going to be making in earnings. But if you are assuming growth, there's going to be more mistakes. So you need to take a margin of safety. There are risks that you have taken. There are uncertainties in your calculations. You take a margin of safety. And only when the company is trading at a price lower than the margin of safety and the intrinsic value, then it is a company you can invest in. So it is simple. It is complicated. It's going to take time. The best way to learn how to calculate the intrinsic value of a company is to just do it. Not just for Apple. Apple is the simplest example. There are other companies which are more complicated. So go and read the 10K, the 10Q forms of these companies. Learn, calculate, make mistakes, and over the long term, probably you'll be a good investor. I have done this recently for a company, Spectrum Brands. I would recommend you watch this video. Have a nice day and goodbye.